Welcome to Am I Catching a Falling Knife? The podcast where we dive deep into stocks that are seeing some recent price action and figure out if there's an opportunity or if it's best to step aside. I'm your host, Dave, and today we're turning our attention to CAVA Group, Inc., ticker CAVA. It's down around 10% after reporting its earnings. Is CAVA a potential falling knife worth considering? Let's dig in. The big story hitting CAVA right now is a disappointing slowdown in their same-store sales growth. That's SSS, folks. And they've even lowered their full-year SSS guidance for 2025. This is happening despite them actually beating EPS and revenue expectations. So the market is clearly saying, hey, growth is king for CAVA, and this slowdown is a red flag. It's raising concerns about their growth trajectory, especially in this choppy economic environment with consumers shifting their spending. Now, what is CAVA exactly? For those who haven't tried it, it's a Mediterranean fast casual restaurant brand. Think customizable bowls, wraps, salads, really leaning into that healthful food with bold flavors niche. They've got locations across the U.S., and they even have a retail segment selling things like hummus and dressings in grocery stores. They're competing in the big limited-service restaurant sector, and as of Q2 2025, they were operating 398 restaurants. Their revenue, 100% of it, comes from these restaurants and their retail products, so you can see why same-store sales are absolutely critical to their success. So, how much could this slowdown in same-store sales actually impact their bottom line? Let's break down the numbers a bit. While the specific figures for the SSS slowdown weren't explicitly stated, the market's disappointment and the lowering of guidance for a growth company usually imply a reduction of maybe 2 to 4 percentage points in expected SSS growth. For our purposes, we're estimating a 3 percentage point reduction. Now, CAVA's latest annual revenue was around $954.3 million. If we roughly divide that by 4, we're looking at an average quarterly revenue of about $238.5 million. A 3% drop in SSS growth translates to roughly a 3% reduction in expected quarterly revenue from their existing store base. Do the math, and that's an estimated revenue shortfall of about $7.16 million for the quarter. CAVA's trailing 12-month gross margin is around 25%. So, if we apply that margin to our estimated revenue shortfall, we're looking at a direct impact on gross profit of about $1.79 million. Here's the kicker. Assuming their operating expenses are largely fixed in the short term, this entire gross profit shortfall essentially flows straight down to their pre-tax earnings. To put that in perspective, we can estimate CAVA's baseline quarterly operating earnings. A typical operating margin for a fast casual chain like CAVA might be around 6% of revenue. So, $238.5 million in revenue at a 6% margin gives us about $14.3 million in baseline quarterly operating earnings. When you compare that $1.79 million gross profit shortfall to the estimated $14.3 million in operating earnings, we get an estimated 12.5% negative impact on their quarterly earnings. That's a pretty significant hit. And remember, this is an estimate. The actual impact could range anywhere from about an 8% to 17% hit, given the qualitative nature of the disappointing slowdown narrative and our assumptions. Now, let's talk about what this stock might actually be worth. To figure this out, I'm looking at it from 2 angles, using data I pulled directly from finviz.com. First, a discounted cash flow model, or DCF. This model helps us estimate the intrinsic value of a company based on its future cash flows. Our assumptions here include a pretty healthy growth rate of about 32.6% over the next 5 years, a discount rate of 9.5% to factor in the time value and risk, and a terminal growth rate of 2.5% for cash flows beyond that 5-year period. Based on these assumptions, our base case DCF value comes in at around $56.89 per share. But when we bake in the impact of our narrative, that 12.5% hit on earnings, our narrative case DCF value drops to approximately $47.22 per share. The second method is a bit simpler, a PEG-based valuation. PEG stands for price over earnings growth, and it's a quick way to assess if a stock's price is reasonable relative to its earnings growth. This method gives us a fair value of about $58.75 per share for CAVA. So, when we combine these valuation approaches and consider the current price of around $84.50, there's a clear disconnect driven by this growth narrative. Given all this, if you're looking to catch this falling knife, we've identified some potential custom buy levels. These are areas where the stock might become more attractive from a valuation perspective. We're looking at initial levels around $55, then perhaps $4,500, and for a deeper discount, potentially $30. These are points where the valuation begins to align more closely with the current fundamental headwinds CAVA is facing. So, to wrap things up on CAVA, as always, folks, this is not financial advice. I'm just here to break down the numbers and the narratives so you can do your own thorough research. Thanks for tuning in to Am I Catching a Falling Knife? We'll catch you next time.